Jordan, good to see you. We have a meaty topic today. 3 ways to reduce your IRMAA for Medicare Part B. If the Social Security Administration considers you a high-income beneficiary, you will pay a surcharge known as the Income-Related Monthly Adjustment Amount. So first tier starts with a modified adjusted gross income of more than $103,000 if you're single, $206,000 for married filing jointly. So Jordan, let's start high level. How does IRMAA work? And what could cause this penalty?
Everyone hates to pay IRMAA because
Yeah.
the more income you have, there's actually a 2-year lag. 2 years later, the government gives you more charges on your Medicare excess premiums. So you got to kind of look at your overall income, look at your plan, and make sure you're prepared for or kind of reduce or eliminate the chances of having IRMAA, because people just hate seeing that 2 years later being blindsided by it.
And so let's walk through 3 strategies then to reduce your chances of being hit with that IRMAA surcharge. And the first one is to consider Roth IRA conversions. Why is that?
Yeah, so if you have your money in a Roth IRA, that's a tax-free kind of investment or a chassis, that when you get income from that Roth, it doesn't affect your taxes and it doesn't affect your IRMAA. So if you have all your money in traditional IRAs and then you have to take income out, that could put you in a higher tax bracket and hit IRMAA, so you pay extra IRMAA on that. So you want to maybe look at the long-term plan. If you can reposition some of those IRAs to a Roth, then you'll not maybe hit that IRMAA in the future. Plus, you got those required minimum distributions, RMDs, that could force you to hit IRMAA whether you like it or not.
Next, you say open and invest in a health savings account. And these accounts are fun because they are uniquely triple tax advantaged.
Yeah, so you put your money in the contributions, you get a tax deduction, they grow tax deferred, then you can take them out for health expenses tax-free and pay for kind of those medical bills in the future, whether that be for Medicare or for any miscellaneous medical situation that arises. So again, you have to make sure that you have qualified to put money into an HSA, check with your plan to make sure it's a high deductible plan, but it's a great way to leverage and maximize your tax efficiency and minimize IRMAA.
And last, you say consider a qualified charitable distribution.
QCDs, these things have been around for a while. It's a great way if you like giving to charity, which a lot of my clients do. Once you reach actually the age of 70 and a half, you can take money from your IRA and send it directly to a charity. That is a non-taxable event. The caveat is if you take that, say, $20,000 out, and then you give it to a charity, you're actually taxed on that.
Right.
You have to directly give that, QCD or that 20,000 from your IRA custodian to the charity. Then there's no tax due, which means less income, which means hopefully less or no IRMAA for you and your family.
Interesting. So clearly, Jordan, some of these strategies require a little bit of proactive planning. If somebody would like to talk through reducing their IRMAA with you, how can they reach you?
Yeah, they can give our number a call. Our main number, 847-499-3454, and we'll create a plan to say what's the best strategy to minimize IRMAA and minimize your taxes along the way.
Great. Jordan, thank you.
Thanks, Aaron.